Hello and welcome everyone. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and this is Trading Places Live. It's Monday, February 14th, 2022, and I'm pre-recording this Trading Places Live for Tuesday, February 15th. Currently, we have futures up somewhat moderately. Got the Dow futures up about 69 points right now, S&P 500 futures up about 16, and NASDAQ futures up about 80. So on a relative basis, we're showing a little bit of leadership from those NASDAQ stocks. It's going to be a very interesting end of the week. Obviously, the market's been under a lot of selling pressure, but we also have Max Payne options expiration coming up on Friday. So we're going to talk a little bit about that today. Let me go ahead and go through that agenda with you for today. We're going to start off with the daily market recap, then do talking technically, Max Payne. So again, talk a little bit about the options, earnings spotlight, and the 3 you must see. So before we get into any of that, let me take you over to earningsbeats.com. If you are unfamiliar with us at Earnings Beats, this would be a great place to start. You just simply go over to earningsbeats.com, scroll down. We have a free newsletter. We'd love to have you join our Earnings Beats Digest community. This is a free newsletter. No credit card required. You can unsubscribe at any time. All it requires is your name and email address. Hit that subscribe button, and then you can enjoy the newsletter 3 times a week, Mondays, Wednesdays, and Fridays. Typically, we try to get it sent out around 8:30 in the morning, which is about an hour before the market opens. You can use these for educational purposes. If you so choose, you can trade some of them. It's usually a very quick read, just a couple of paragraphs and a chart featuring earnings, relative strength, candlesticks, gaps. I mean, all of the things that we tend to focus on at Earnings Beats. But I think you'll find it very educational, and we'd love to have you. So make sure you go to earningsbeats.com, scroll down, and sign up for our newsletter. I wanted to mention a couple of events. So if you are on our homepage, by the way, all you do is click right here on this February educational series, and it'll take you to a landing page where we have 3 events. The first event was completely free. That was the January effect held on Saturday, February 5th. If you missed it, no worries. You can go right down here and you can click to view the recording. It simply talks about the old Wall Street adage, as goes January, so goes the year. And it points to the past where we've seen poor Januaries typically result in poor balance of the year results. So February through December tends to be not so great if you've gone through a really rough January, which of course we have this year. So I would suggest you go through and check that out. It is completely free. You can just click there for the recording. And then over the weekend, we had our second session, which was the anatomy of a cyclical bear market, where I went through, pulled up all of the cyclical and secular bear markets that we've had since 1950 and walked through them, looking at severity, looking at the duration, some of the things that we can expect, because I do believe we are in a cyclical bear market. We haven't reached that 20% threshold at this point, but I think we are going to do it. I believe it's inevitable, given all the issues that we have, and now a number of the technical breakdowns and all of our intermarket relationships, everything to me, sentiment, all of it is pointing to more weakness ahead. I've been writing about it, talking about it now for about 6 weeks, and I don't think it's going to stop anytime soon. We'll get bounces from time to time, and honestly, with options expiration coming up this Friday, this will be a perfect opportunity to get a little bit of a bounce maybe in the near term, but we'll talk more about that at our Max Payne event, which we have on Tuesday at 4:30 p.m. Eastern. That is for members only at Earnings Beats. So this is a great time to take out a 30-day trial, because the event that we had last Saturday, this anatomy of a cyclical bear market, you can, there is a recording and you can click to get the recording, but if you're not a member at Earnings Beats, you're going to have to join for a 30-day free trial in order to get access to that recording. And also we have an event coming up on Saturday, which is the 3rd session in this February educational series, and that is the most overlooked growth stocks. So I believe we're going to get to a point probably in the next few months where we are going to bottom. And if you can catch these growth stocks at the right time, I think you can make a fortune, small fortune. I do believe growth stocks will be back. I don't think it's over. I know a lot of folks, as soon as the market starts turning down, they think it's, Armageddon, Great Depression 2.0. I don't believe any of that. I think the market in a year will be back, or maybe even less than a year, we'll be back at all-time highs. But I do think we have some pain to go through in the near term. So this session is going to be designed really just doing some homework and preparing. It's kind of like an NFL coach putting together a game plan. You don't start playing during the week. You have to wait for your game to start. Well, here we have to wait for the bull market to resume. But I think there are going to be a number of growth stocks that we're going to want to keep an eye on. So that's going to be this Saturday, the 19th. And again, that is for members only. So if you want to attend that, also our Max Payne webinar, which is Tuesday at 4:30, both of those are for members only. And we will be also hosting our draft for our portfolios, looking to fill out all of our portfolios. That'll be held next Monday. And that will be Monday, the 21st, President's Day. Market will be closed, but we'll be having our draft in the afternoon that day. So anyway, access to all of those events, you get it with a 30-day free trial. So if you scroll all the way down here, you'll see a form where you can fill out to start your subscription. We'd love to have you. All right, daily market recap. It was a little bit of a wild day. It looked like maybe in the morning we were going to have a pretty decent day, and then we saw the selling. It looked like, oh my gosh, here goes another sell-off. And then we rallied back at the end of the day, and for the most part, finished somewhat near the flat level. I mean, we were down a little bit on the Dow. You can see down 172 points. S&P down 17. NASDAQ was flat. NASDAQ had turned much lower, but it did rally back in the late afternoon to get back to the even point. Mid caps were down 11, small caps down 5. So everything was down, but seemed like it could have been a lot worse heading into the close. Discretionary stocks, really the only major area of strength in the market. This group was up almost 0.6%, and that helped to keep the market from selling off further. Energy down 2.3%, financials 1.1%, real estate down a little more than 1%, and healthcare also down a little more than 1%. Outside of energy, which you can see still in a nice uptrend, everything else, you got discretionary pretty weak, real estate very weak, healthcare weakening. Financials kind of in the middle. We got a nice breakout earlier in 2022. Then it looked like we were falling apart a couple weeks later, and then 2 more weeks later, we were right back near the highs again. So it's been a wild ride for the financials of late. But overall, I think the market just seems like it is trying to roll over, and I believe we're going to go lower. The 10-year Treasury yield, we did see that rise 0.4% on Monday, so we closed up near 2%, 1.996. On Tuesday morning, we have the January PPI coming out, so another inflation report. We know what happened last Thursday when we got the CPI, and I tend to follow the CPI a little bit closer than the PPI, but both are important. The PPI for January expected to rise 0.5%. December rose 0.2%. So we're looking for that to accelerate a little bit. Stripping out food and energy, the core PPI is expected to rise 0.5%. December also up 0.5%. Also on Tuesday morning, we're going to get the February Empire State Manufacturing Index. January was pretty flat. It went down about 0.7. February is expected to rise to 10. But I do want to point out the range. The analysts are all over the place. The range I'm showing is from 3.5 all the way up to 21. So those will be your economic reports to watch in the morning and see how the market reacts to those. But I do expect that this overall uptrend in the 10-year Treasury yield is likely to continue. I wouldn't be surprised to see us, now that we've gone through the high from a couple of years ago at about 1.97, I wouldn't be surprised to see us continue rising over the next few months. And I think that's going to spook the market. The stock market, I should say. All right, moving on to talking technically. I wanted to go through 4 head and shoulder patterns. You may have already recognized these. I've gone over some of them in the past. but I wanted to just summarize these four. So the first one, and I think this is a big one, the large cap growth index. This has been the one area in the market that has really held up the S&P 500, these large cap growth stocks. Apple, Microsoft, Google, Tesla, I mean, all of these companies have been very instrumental in keeping the S&P 500 afloat. But we are really looking at a chart that seems to be weakening by the day. I see a down sloping head and shoulder pattern, which I think is very bearish. You can see the left shoulders here, the right shoulders here. That's down sloping. You can see the close here. You can see the close over here. That's down sloping. That's your neckline. Shoulders down sloping. The measurement from the head all the way down to the neckline, roughly 15%. And if we go down another 15% or so, that would, if we break below 5,200, that additional 15% would take us all the way down close to 4,400 on this index, which would be a pretty substantial hit from where we were at the end of December at over 6,100. So we could be down, you know, roughly 27, 28% by the time all this is said and done. All right, let's see, another head and shoulder top. How about the Dow Jones? I mean, the Dow Jones, there's your left shoulder. Here's your neckline. There's the head. Here's the right side of the neckline. Intraday, we broke below, which I think is bearish. Short term, we put in that hammer. So it's short term bullish. We got that rally. Now we're starting to roll back over. I think the right shoulder has now been established. It is a down sloping right shoulder. Break below 34,000 on the Dow, I think measures down close to about 31,250. So keep an eye out for that. S&P 500, this one I have gone over quite a bit. Left shoulder back at the beginning of September, beginning of October, set the left side of the neckline. Right at the end of December, when those defensive groups were leading the market to the upside, that established the head, came all the way back down to 4,300, the left side of this neckline over here. We tested that, actually went below intraday, came back up, held it. We rallied for a bit. Now we're starting to roll back over again. Eventually, I see a close below 4,300. And if we do see that, look for a measurement down to probably close to 3,800. That would be the initial measurement. That's not what I'm saying is, you know, that's, I think we could go down even further than that. But watch for that break at 4,300. That would be your signal. And then the last one I wanted to show you, head and shoulders, was technology ETF, XLK. By the way, all four of these that I've shown you, Apple is a big component of all of these, Apple and Microsoft. So those are two big key stocks to watch, because if they continue to weaken, that's going to make it difficult for all four of these charts to hold on to neckline support. Technology, you can see right here, left shoulder, beginning of September, beginning of October, left side of the neckline, same general chart. This one, we did see a right shoulder that went up above the left shoulder. So if there's a little bit of a bullish slant to this one, that would be it. But we went right up to where we had failed. See all these lows coming down here around 163 to 165. Notice where we failed on the way back up, 163, 165, right in that area. So I think we're rolling back over. We lose neckline support around 148, 147.5. And that is where we would probably be looking for a measurement on this breakdown down to about the 123 level. And if the XLK, which is currently at 154, falls to 123, you can imagine where we're going to be on the S&P 500. It's not going to be pretty. So at least be careful, be aware of these patterns. If they break, you might be of the opinion, hey, I'm bullish. I don't think we need to be looking at topping head and shoulder patterns. Normally, I would agree with you. I think the difference here is that we've got a lot of intermarket relationships. We've got sentiment indicators, a lot of different things lining up for the market to go lower. So if there was none of that, and we just simply saw this pattern in play, I would tend to agree that we're not going to break the neckline. We'd hold it and just go up to new highs. But with all these other warning signs, I really think you better be careful if we do lose the neckline support on these four charts. All right, next up, Max Pain. So what we do every month is we go in and look at both the Spider and the QQQ. So Spider tracks the S&P 500. The QQQ tracks the NASDAQ 100. And what we do is we look to see in the options world, how many open interest contracts that we have in the money on the call side and on the put side, to try to get an idea, to help give us a directional clue as to where market makers might want to try to move the market in the near term. just to cut down on the amount of premium that they have to pay on these options. So every month, I always look at the spider. I always look at the QQQ. And then normally we'll find, maybe another 6 or 8 stocks that could move either higher or lower, depending on or based on the options activity on those particular stocks. So stocks that have been beaten up a lot going into option expiration week, many times we'll see a rebound. And that's really what we have with the QQQ. So I thought I'd just kind of point out the QQQ and where we stand and where we could go. So the QQQ, we closed at 347.49. Now, if you look at the CBOE and go to the QQQ, so when you go to cboe.com, click on data, click on quotes dashboard, and then click on a symbol, click on options, and it'll come up here, and then just make sure under expiration you use standard, which is the monthly. Make sure your options and volume, the options range and volume is set to all, February expiration, and then view the chain. And then this is what we get. So 347 is where the QQQ currently resides. So here at the CBOE, here's 347. So everything below 347 on the call side, all of these calls are in the money. So this is this INT column. This is open interest. So you can see there's 7 calls still open from the QQQ 200. Congratulations to anyone holding that. And then you can see as you start moving up, you'll see more and more options in the money that are being played, and you go all the way up to 347. Now, I went back and looked earlier, and there's probably less than 40,000 contracts total. 40,000 contracts total in the money right now on the QQQ. That's all. Because we've come down so much, it's wiped out almost all the calls. When you look above 347, look at all of these calls that are basically worthless right now. I mean, 60,000 calls at 400. We're at 347. What are the chances we're getting to 400? $53. What are the chances we're going to go up 15%, 16% in the next 3 days, 4 days? Probably not very strong. So I think these options are going to expire worthless. Most of these are going to expire worthless. Now, getting back to that 347 level. So we're talking about 40,000 contracts in the money, call contracts. How about puts? Anything above 347 would be in the money. If you're holding a put on 348, you're in the money. If you have a put 349 in the money, 350, obviously, you're getting more and more in the money, and the value of your calls, or excuse me, the value of your puts are going to be much higher, as you get further out, because you're going to be deeper and deeper in the money. So from 347, I want you to look at all of these puts. Remember, I said there are only about 40,000 calls in the money. Puts, there's 12,000 at 348, 5,000 at 349, 58,000 at 350, 2,500 at 351, 5,600, 352, 6,600, 353, 6,700, 354, 21,355. I mean, going down the list, 42,000 at 360, 31,000 at 365, 22,000 at 370, almost 20,000 at 375, 39,000 at 380, 6,500 at 382, 10,000 at 385, 23,000 at 390, 17,000 at 400. Do you see the imbalance? I always try to draw the analogy, and this dates me, but of a seesaw. If you're familiar with how a seesaw works, one person on one side and the other person on the other side, and they go up and down. Well, max pain is the point where both sides of the seesaw, the legs are dangling. Right now, what we have is almost everything. All the weight is on the one side of the seesaw with the put value. All of these puts, there's tremendous value of in the money puts right now. What does that mean? Well, it means that market makers who have very little call premium and a ton of put premium, it would be better for them if the price were to start moving up a little bit. Because what you want to do is try to get to the point, or at least move in the direction of where your calls and puts would balance, and that seesaw would go back to the feet dangling on both sides. And so there's a lot of work potentially to the upside. Now, does this mean that this is a guarantee that the market's going to move higher this week? Absolutely not. Market makers are protected. They are generally protected if, we don't get to the point where the feet are dangling on both sides. Even if it's still heavily skewed toward one side or the other, market makers are fine. Don't worry about them. If it comes down to where you have a lot of in the money calls, what market makers can do is just simply be buying the stock. And while everyone else is buying the calls, they're selling the calls. So they buy the stock, sell the calls. It's covered call strategy. Okay. Now, if there's a lot of puts, then they can short the stock to protect themselves from all the puts that are out there. So they can protect themselves just fine. They don't lose money. The point here is they can make a lot more money if prices start heading in their direction. So it's not a guarantee, but it's almost like it's like a gravitational pull. Maybe it would be a good way to describe it. So if we finish the QQQs instead of 347, if somehow by Friday we're at 357, market makers would save a lot of money. All of a sudden, all of these puts that are currently in the money, if we closed Friday at 357, they'd all be worthless. Now, these calls would start gaining in some value, but there were a lot more of these puts. So the savings on the puts would more than offset what they would have to pay out on these calls. So it's just a balance, like I said, almost like a seesaw and a gravitational pull. So I would expect that the QQQs probably have upside action, but we could go down for another day or two first. I mean, we're in a very volatile market right now. I hate to, say we could do this or we could do that, because obviously we're going to do one or the other. But I think what we know is with the volatility index high, knowing the options and where it would behoove market makers to take the market, we could see upside action. But we were also in a market that is seeing intense, impulsive selling that's taking place. So trying to pick when the bottom, a potential bottom, might go in is hard to do. Technically, I'd love to see over the next couple of days the S&P sell off and go below 4,300 and then come back with another kick save as we approach options expiration, because then I think maybe we see a nice 2, 3, 4 day rally, even into the beginning of next week. Because remember, a lot of these contracts, you can exercise the contracts and either buy the stock with calls, or you can sell short with your puts by exercising. So there's still incentive for market makers to do their thing into next week, the beginning and part of next week. So I always say the market can be manipulated into Friday, which is option expiration Friday this week, or even into the following week, a few days. So I would say in the next Tuesday or Wednesday. But these next 4, 5, 6 trading days are going to be really, really interesting. All right, earnings spotlight. I wanted to show you, if you're unfamiliar, if you do sign up for our free newsletter, which is the one I talked about at the beginning of the show. If you sign up for this, every newsletter, we give you a link where you can download these upcoming earnings chart lists for free. So for instance, Monday after the close and Tuesday before the open, there will be a large number of companies that will be reporting. Some already have reported after the bell today, and others will be reporting Tuesday morning before the opening bell. What you can do is just highlight this and save this password, or copy, not save, but copy the password, and then click on this link and then paste the password and unlock the list. And then I can save the chart list. I already have this set up, 214 to 215. So Monday after the close, Tuesday before the market opens, I have a chart list already set up. I'm going to download right into this. So I'm replacing this list, which right now has nothing in it, and I'm going to save results. And that's how quick we do research and just hand it off to you. This is free. This is anybody who's in our Earnings Beats Digest community. And then what happens is if you click on the chart now, and I'm going to go into this chart list, which I just put all these charts in here. And these are the charts. These are the companies that will be reporting over a billion in market cap on Monday after the close or Tuesday before the open. All of the ones here that start with 0 all the way down to 0017, these are all Monday after the close. Anything starting with 1001 all the way to 1028, these are 28 companies that will be after the market, or excuse me, before the market opens on Tuesday. And within those two categories, they are in market cap order. So the larger cap stocks will be at the top in 1001. The larger cap, or the smaller market cap, would be like 1028 USAC. That's going to be closer to the 1 billion level. Now, the beauty of this is once the stock market opens, once the stock market opens, you can pull this chart list up, view all, and hit the summary, and then sort it by percentage change. And at 9:32 in the morning, you'll be able to see every company that's reported in one chart list at one time. It's a very, very quick way to see what's going on in the market. And you can sit there and just click through it every 5 minutes, every 2 minutes if you want, and see what is moving, because you normally get a lot of fast movers. So if you like to trade, especially if you like to trade right after earnings, I think this chart list will really do you well. But we have all of these chart lists listed here, so something to at least consider. All right, as far as the earnings go, let me pull up one that ANET reported after the close. They are showing that they're up 7% after hours. And basically what I wanted to show you is the AD line's going up. The price of the chart mostly is going up, even though, we topped back in December and we've pulled back a little bit. But look at the relative strength versus its peers. It's up near a 52-week high. So you've got a really strong stock within its peer group. Nice AD line. Looks like it's being accumulated. And the stock came out with great numbers. Then let's look at Omnicell, the same another company that reported earnings after the bell. Look at the AD line. See the difference? It's now near a 52-week low. Price action down not too far from probably a 6, 7, 8 month low. Look at the relative strength the last 2 or 3 months going straight down. Look at the group itself relative to the S&P 500. So you got a weak stock within a weak group with a AD line near 52-week low. You know what the stock did after hours? Came out with its earnings. It's down over 5%. So stock was up at 160 2 days ago, and now it's going to probably be down around 140 at the open tomorrow, unless things change overnight. Anyway, thought that was interesting. Let's move on to the 3 you must see and wrap this thing up. Going to start with Newell Brands. Nice breakout here over these recent lows. Nice volume coming in. AD line starting to turn up. I think this is an interesting chart. Maybe a test of the 20-day down the road might be an interesting long trade. Moderna, my gosh, finally that AD line rolling over. Stock has just been getting hammered, set another new low in 2022. It's been down quite a bit already this year. Volume picked up. It lost that 150 level. And the last one I have is CF, which is CF Industries. They report earnings tomorrow. I think this should be a strong report. AD line strong. Relative strength's been climbing. Looks really good in this commodity area. Look at the volume coming in on the move. Nice trend channel moving up. I expect a good report here out of CF. All right, that's it for me. Appreciate you tuning in. I'll be back at Earnings Beats for your next Trading Places Live. That will be on Wednesday. All you have to do is go over to Earnings Beats, by the way, and Trading Places Live right here. Just click on this around 8:45 or later in the morning on Wednesday, and you'll be able to come right into the room and check out the show. Appreciate everybody again tuning in. Have a great Tuesday. Be careful, everybody. I think there's a much better market down the road. So let's try to cross that bridge together. Happy trading, everybody.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.